Okay, let's go ahead and get started. All right, so today our first topic is going to be on financial leverage. We're going to kind of go through all of the material associated with, I guess, quiz number 7, which will be chapter 12. After we finish that material, we're going to talk a little bit about your project for this course, which we haven't done up to this point, which is obviously the last day of class along with your third test. And then we are going to take quiz number 7, and then we will be taking our test number 2. Okay? So that is the order of our agenda for today. So, starting out, financial leverage. This is probably, in my opinion, the #1 topic whenever people really, truly begin to understand commercial real estate, is understanding the value and sort of also the downside associated with financial leverage. So, for those of you that obviously have a little bit of background in real estate or finance, what is financial leverage? Just give me a couple of words, like 1 or 2 sentences.
Borrow money from somebody at a lower rate for a project, expecting that project to return a higher rate.
Okay, so basically being able to get money from another source for your project at a lower cost or lower rate of return, but then be able to generate a higher rate of return off the project and then use that higher rate of return to not only pay off that loan or that investment from somebody else, but give you an overall higher rate of return. Or more even simply put, borrowing money at a low cost and being able to leverage that into a higher rate of return for yourself, okay? Now, let's just kind of go through a really simple example of a project that would be considered to be unleveraged, okay? Now, first of all, when we talk about the term unleveraged, all that means is you're using all equity, okay? You're not borrowing anything, okay? So there's no debt. So an all equity deal might be you've got a project that the cost is, let's say, $100,000, all right? And the return each year that this project throws off is, let's say, $10,000. Okay? So your rate of return is 10%. Okay? Does that make sense? Okay, which is pretty much just ERV, okay, or kind of almost like a cap rate. All right? So, once again, what you've got going on, just to keep things really basic and simple for the moment, is we've got an income up here or return of $10,000 a year. We have a cap rate or rate of return of 10% per year, and that means our overall value, or in this case, our cost, is $100,000. Okay, so I'm just trying to make sure we present it a couple of different ways. Okay, now this would be an example of a very simple, unleveraged rate of return. Okay, meaning you're putting in the full $100,000 as cash money out of your back pocket. You're not borrowing any money from anyone. Okay, is everybody clear with that? Yes or no? Okay, so now, and just to make this example really simple and kind of keep it in the back of your mind, think of this as like a cheap single-family house. Okay, now you couldn't buy one of those here in Florida for that price, but in Texas you could easily buy one for $100,000 or less. Okay, actually one of my best friends in Texas just bought a handful of houses in a little tiny town called Hearn, Texas, and was paying like $50,000, $60,000 for these 3-bedroom, 2-bath houses. So it's hard sometimes to put in perspective that other parts of the country, how radically different price points can be. But anyway, just assume this is a single-family home of $1,000 and it's generating $10,000 a year in rental income. Okay, now. if we put together our overall little formula for sort of financial leverage, it's basically going to look a lot like weighted average cost of capital, because that's pretty much what it is. All right, so those of you that have had any sort of finance courses, you have probably seen this in a slightly different form. So let me just kind of go through and explain. I may have mentioned this at one point or another, at another point in the class. All right, so what we've got over here is sort of the debt side. And over here, we have the equity side. And so here, we're going to sort of say this is our loan to value, and this is basically our interest rate on our loan. Over here, this is the equity that we put up, or the equity percent. And then over here is going to be our return on equity. Okay? Now, in this particular example, what we've got is a loan to value ratio of what? No. 0. We're not borrowing anything. Therefore, 0 loan to value, which would mean that our equity percent is going to be what?
100%.
100%. Okay? 100%. Okay, so 0% over here for our loan to value. So therefore, whatever interest rate that the lender is charging is irrelevant to us, because whatever it is going to be multiplied by 0, and it's not going to matter. But we'll go ahead and put in an interest rate just for fun. We'll put in an interest rate, let's say, of 5%. Okay? All right? Now we come back over here to our return on equity. All right? Well, if we do the math, as I was saying, obviously anything times 0 is 0, so we would have 0 there. Okay? Then on this side, all right, so what we're going to do is we're going to take that 10%, okay, and do what?
Minus 0.
In other words, we already pretty much know the answer, but I'm just going to go ahead and I want you to try to figure it out mathematically. The answer is going to be a return on equity of 10%, okay, because 100% times 10% is 10%, okay, and then 0% plus 10% gives us 10%. Okay, now there's a reason I'm doing this, because this is demonstrating there is no financial leverage. It is purely a simple rate of return based on an all-cash deal. Okay, is everybody clear with that? Yes or no? All right, so my return on equity, just to make sure everybody is clear with that. My return on equity is this 10% here, which just simply says, for every dollar that I put into this deal, I'm getting back 10 cents, okay? Or in this case, if I'm putting in $100,000, I'm getting back $10,000 each and every year, okay? Everybody cool with that? Yes? All right. But let's just say for a moment, what I actually have available to me is $100,000 cash, okay? Which is what we're sort of saying here. So why would I not take that $100,000 cash money that I've got and leverage it in such a way so instead of getting one house, I get 10 by putting in a 10% down payment on each home that I buy. Does that make sense? So therefore, I could buy 10 houses with that $100,000 seed money, but then ultimately control $1 million worth of assets. Okay, is everybody clear with that? Yes or no?
Yes.
Okay, so let's just sort of take that and kind of work our way through it. Well, if that is the case, our little model, okay, that we thought, well, actually we're not going to do it that way, we're going to do it another way. So what we're going to do is we're going to kind of go over here and we're going to put in those characteristics that we just talked about. Let's sort of see what we have. Okay, so first of all, what's going to be our loan to value under that circumstance? 90, good, you're thinking. So a 90% loan to value, okay? So we got $1 million worth of properties, we're putting in $100,000 and we're borrowing $900,000. Does that make sense? Okay? So that means our equity percent, what are we contributing in equity?
10%.
10%. Okay? Everybody still with me? All right? Now, the properties themselves, okay, the individual homes, what are they returning each year? A 10% rate of return, yes?
Yes.
That's right.
Okay? So that's still saying the same. Okay? But what's changing here? Well, what's our interest rate? 5%. We just bring it down from above. So what's going to change for us
Yeah, return.
is the actual return that we are going to generate off of that sort of deal structure. Okay? So let's do the math. Okay? 90% times 5% should be what? Like 4.5?
Yes.
Okay? So that means if we've got 4.5 here, then what does that mean this has to be over here?
5.5.
5.5. Okay? And then 5.5 divided by 10%. Oops, turn my calculator on. So we get 55%?
So that has to be 5.5 because it has to equal 10%, right? 10%. And yeah, I see it because it says
Okay.
subtract
So in other
5.5,
words,
4.5,
okay,
and
so
10%.
this
I
number
see.
and this number
Yeah,
together
100%.
have to equal 100%. Okay? Always. All right? The other numbers, in terms of, let's say, the interest rate, that is just, whatever the interest rate is from your lender. Okay? So in this case, we just said we're going to make it 5%. All right? And then backing into whatever our return on equity is, this 55%, that is going to be dictated, obviously, by what is down here, divided by, obviously, in this case, the percentage of equity that we put into the deal. Okay, does that make sense?
Yeah, I got it.
Okay, now let's just kind of back it up and see if we can make it work another direction. Okay, just to kind of do proof of concept. All right? So let's see if it works.
I mean, I get theoretically how you're getting the 5.5, but
Okay, let me try something and then we'll see if we worked it out right.
okay.
Okay. So let's put the actual numbers. Okay, the actual numbers are, yellow, 900,000 and 100,000. Yes?
Yes.
Okay. So let's do this. Let's take $900,000, which is the amount we're borrowing. Yes? We multiply that by 0.05, which is the interest rate. Yes? Okay, so let's just start with that.
5,000.
So our interest costs on this are $45,000. Yes? Okay, everybody with me? Okay, then our equity is 100,000, and we're saying that supposedly is generating a 55% return for us. So 100,000 times 0.55 would be a $55,000 return for us. Add those two together, and we magically get the total $100,000 that the project would be yielding. Because think of it like this. this project is now yielding a $100,000 income with $1 million value. Your cap rate or rate of return is still 10%. Okay, so what you have done through this is that by borrowing this $900,000 at the 5%, when the project itself is yielding 10%, you have leveraged, or you have freed up the money that you would have paid to yourself in terms of a 10% rate of return to basically be able to pay yourself that much more. So in this case, instead of paying yourself, $10,000 on one house, you're now able to pay yourself $55,000 on 10 houses. Okay? We're saying, well, wait a second, that's less money per house. No, it is per house, but the thing is, you're only having to use you're using the same amount of cash. So you're using $100,000 cash to generate initially only a $10,000 as income stream. You're using that same $10,000 over here, but you're generating a $55,000 income stream. That is a much better deal, okay? Now, that is wonderful, as long as the project is yielding above and beyond your cost of capital of the 5%. If for whatever reason your rents go down and the rents go down below that 5%, you're going to be in a world of hurt because you're now going to have negative financial leverage. Okay? All right, Adam. Sorry. Got me doing it now. All right.
It's the hair.
So the 55% then, I think she just caught me up to speed on it. But that's, you're taking whatever your rate of return is, subtracting out the first part there, and that's what you're using.
Yeah, you're back solving to get your return on equity.
Okay, okay.
All right, so you know if the overall return is 10% and you subtract out 4.5, that means you've got 5.5 on this side of the equation. If this is the only empty space, and you're taking this number divided by this number to give you that.
Okay. Got it.
You just back solve. Okay? Okay. Thoughts, questions, observations? Yep, go.
This probably stems from a saying I hear from developers: you can borrow more than you can earn.
Yep.
You know, and they
Well,
live by that.
Yeah, the whole thing, I mean, and that can be interpreted a couple of different ways. You're saying you can borrow more than you can earn. Well, in some cases, if you borrow too much, you may not have sufficient cash flow to be able to pay down the loan. But you can also, sort of look at it from the other way, which is by borrowing, it gives you the ability to magnify what you can potentially control. Okay? I mean, in other words, this simple example, this is pretty extreme. I can buy one house, I can control a $100,000 asset. Now, granted, I own it free and clear. Okay? I have no lender, no one breathing down my neck. If all of a sudden the market drops out and the rental income goes to nothing, I haven't really lost anything in terms of the actual asset, other than, yeah, maybe the asset's worth less, but I'm not in the hole for anything, okay? Whereas on this side, now all of a sudden, I control 10 houses worth $1 million altogether, and as long as everything positively cash flows over however long the period I have a loan for, whether it's 10 years, 15 years, 30 years, whatever it is, supposedly at the end of that term, I will own those properties free and clear and be able to obviously now have free and clear cash flow for many years to come. Does that make sense?
So that 45,000, wouldn't that be like the debt that you're paying?
Yeah, that's exactly what it is. This is
But
$900,000 of debt
Right.
times a 5% interest rate
Right.
means $45,000 a year in interest.
That you're paying.
You're paying.
Correct.
But you are receiving off of the 100,000 you're putting in a 55% rate of return, so you're receiving 55,000. The total of those two is the overall return the property is generating, which is the 100,000.
But it's not generating that 45,000 for you.
I'm sorry, what?
It's not generating the 45,000 for you as the investor. It's generating for the interest you're paying.
Yes, this is an outflow, this is an inflow to you.
Right. So really, what you're only making is 10,000.
No.
No.
No,
I mean, as the
okay, here's what's happening. Let me make sure that I'm very clear on this. These 10 properties are generating $100,000 a year of income.
Right.
Cash flow. That is hard currency. If we could pop down $100,000 cash money on top of this table that you would generate from the properties. Of that 100,000, you give 45,000 away to the bank. You get to keep 55,000 for yourself. Okay? Does that make sense? Okay? So instead of only getting to keep 10,000 in the first example, you're now getting to keep 55,000. That's a heck of a difference. Okay? It's less per house, but it's more overall. Okay? Well,
No one's saying it's gross, 55K gross, right?
yeah.
So after you subtract all the expenses, you might still.
Yeah, you still have other operating expenses. You subtracted the biggest one, which is strictly the loan.
Okay.
I mean, yeah, you're still going to pay property taxes. You're still going to have to pay, whatever. But you're still generating the same amount per house in terms of whatever the rentals are, and then you're still paying whatever the same expenses are. It's just that this is basically before tax. This is what it's after expenses, because this is NOI. Yep.
So the first example would generate 10,000 of equity, and the second one's generate 55,000. But the first example, you don't have any debt, but you're still generating more in the second example.
Okay. So example 1 is 1 house. Example 2, 10 houses. Oops. Example 2, right what I'm saying. Example 2 is 10 houses. Okay? With example 1, you receive $10,000. With example 2, you're really receiving $55,000. But your costs over here are 0. That means your total is basically you're receiving $10,000. Here you've got $45,000 that you're having to pay for fees and whatever, but your total income is $100,000. Okay? Does that make sense? The what matters is really this, which is how much are you receiving? So you're receiving $5,500 per house, if you want to look at it that way. Okay, 5,500 or 55,000 divided by 10. Okay, does that make sense, everybody? Yes or no?
This is a question, what do you want to know? You want to know the amount of money that you're going to take in minus the debt.
That's part of what you want to know.
For.
Well, it depends.
Yeah.
In this particular example, I'm just saying, okay, we want to know how much can we increase basically the amount that we're receiving on an annual basis from this deal. But we may also be interested in being able to answer what is our overall return on equity on this deal. Because this is the number that really then begins to kind of tell us what our true rate of return is regardless of the dollar amount. Okay? So, in other words, if the first example, we were getting 10% rate of return, second example, we're getting 5.5 times that, we're going to be really happy with that.
We shouldn't even worry about how many houses you actually have to buy. None of that really matters.
Right.
You're looking for them increase your rate of return.
Increasing your rate of return. Okay? But the relationship with respect to the debt and the equity are all going to drive that. In other words, if our cost of debt here goes up from 5% to 10%, okay, let's just take that as an example. If this goes up from 5% here to 10%, I can tell you without even having to go through and do the math, that is going to reduce your return on equity down to 10. Okay. Hold on. I want to just show what I'm talking about with it, not lying to you. Okay. Okay, so we had it set up 90% loan to value, 5% cost of debt, we had 10%, and then that gave us, when we back solved into it, 55%, okay? That's what we just had, all right? And so what I was saying is, all right, what if we come in here, but now our cost of debt, let's say, goes up to 10%, okay? In other words, our cost of borrowing, our interest cost. All of this is going to stay the same, but when you back solve, what you're going to find is your return on equity goes back down to 10 because now there is no financial leverage. And the reason there's no financial leverage is because your cost of debt now is equal to the overall return on the project, which then will make it equal over here for your return on equity, okay? So the only time that you're really able to achieve, now this is not inherently a horrible thing. Let me make sure this is clear. You know, because somebody would say, well, wait a second, I'm still getting a 10% rate of return, but you're also taking on a lot of risk that now you're putting yourself where your margins are basically non-existent. So that if all of a sudden the overall return here were to drop just a teensy bit, this is staying fixed, and then now this is going to be a negative return. Okay, does that make sense?
Just break even here.
I'm sorry?
Just break even.
Yeah, you're break even, right? Or, well, you're a little bit better than break even in the sense that you are still generating a 10% rate of return. Okay? Because you're still breaking even at a 0% rate of return. Does that make sense?
Yes.
How do you back solve for a 10%?
Okay. Just think of, when you're back solving, just think of the opposite of the forward solving. Because forward solving is just going to be taking this times this, which is going to be 9%. This times this is going to be 1%. Okay? So that plus that gives you 10%. Okay? So to back solve, all you're going to do is you're going to say, okay, if you don't know what those are, you do know that 10 minus 9 is 1. 1 divided by 10% is 10%, or not 1.10, but 10%, okay? All right. Okay. Now let's change this up a little bit. All right, so one of the things I said, well, what if things go sideways in the sense of maybe all of a sudden interest rates change, okay? If interest rates were to go up, let's just say they go up to 15%, okay? Originally, they were 5%, then we raised them to 10%, now we're gonna go whole hog, raise them to 15%. Well, right off the bat, you should say to yourself, wait a second, my project's only yielding a 10% rate of return. How in the world can I afford a 15% cost of debt? And you really can't, okay, unless you go into the hole in terms of taking a loss. All right, so we do this, 90 times 15%, 13.5. Okay, well, 10% minus 13.5 means what? We have a loss over here of 3.5. Does that make sense? Yes or no? I mean, it's simple math, okay? 10% minus 13.5% gives us negative 3.5%, okay? All right. Now, so if that's the case, negative 3.5 okay, means a negative 35% as a return on equity. So meaning that for every dollar that we invest, we are losing 35 cents. Okay? Not a good thing for us. Now let's put the real numbers there to see what's happening. Okay, the real numbers, we said this is $100,000. Okay, but now we've got, well, let's just do it down here. Okay, so we've got $100,000. We still have our $900,000 that we're borrowing, but we're borrowing that at a 15% rate. $135,000. Okay. And over here, we've got the $100,000 equity that we're putting in, but what we're saying is that we are losing 35% of that. So 100,000 times 35% would be a negative 35,000. So 135,000 minus 35,000 gives us our 100,000. Okay, so this is a loss now of $35,000 because of the increase in our overall cost of borrowing. Does that make sense? Now, where's that $35,000 come from? Us. In other words, we would have to come up with it out of our back pocket. Now, that's in addition to the $100,000 that we have put into the deal up front as our equity. We're not getting to like take that money directly away from our equity. This is in essence more money that we have to give to the lender. This is like a capital call, okay? So we have given the lender $100,000 whenever we borrow the money on this property. Now we're having to give them in this first year, because of this loss, an extra $35,000 to make them whole and to leave us alone. But here's the thing, it's not over. If we continue to own this property for one more year, that's another $35,000 that we've got to come out of pocket. And each year we own it, another $35,000. So after owning this property for, let's say, 3 years, we're going to be into it, not only for the $100,000 we put in initially, but basically an extra, you know, whatever, $105,000, okay? So $205,000 total, okay? Do I follow? This is the downside. This is the negative financial leverage. This is what happens to developers whenever they get in over their head. They spend too much money, they borrow too much money, you know, they're trying to finish the deal, they're trying to make it work, and the reality is the economics are simply not there. The rent levels aren't sufficient to support basically the kind of project that they have built, and therefore they can go out of business very quickly, okay? Because if their assumptions are that they're going to get, you know, a cost of borrowing at, you know, 5%, but all of a sudden the lender says, well, no, it's 10 or it's 15%, then that makes this overall rate of return, you know, a really negative thing for them. But see, that's assuming that it's the interest rate changing. This return can also change too. So in other words, all that has to happen is your rents drop because you've got extra competition in the market. Everybody else is building the same thing you're building, and so you've got to drop your rents. So now your overall return maybe, instead of 10%, maybe 4 or 5%. Well, then we go back to this, you're still not going to make any money. Okay? Does everybody follow me? Yes or no?
My question was, how did you get the initial rate of return? You just came up with an arbitrary one just for the power problem, right? But how would you?
The initial rate of return is simply based on per house, $100,000 cost, a $10,000 a year income, and that would be a 10% rate of return.
Income is rent or whatever.
Right, it's rent, NOI. Okay?
So then that's, so when arms kick in and the balloons come around, that's why they sweat whenever the.
Sure, the interest rates are going up. Because this is a prime example of when interest rates are low, you do very well as an owner of real estate. When interest rates go up, not so much. Okay? Okay. Yes?
One thing that I found really helpful for me whenever I was learning about real estate investing was like, when you're looking to buy property in a neighborhood, looking to see what the cycles have been doing in that neighborhood, real estate cyclical, and making sure if the market tanked and the real estate went down to, say, what was the affordable rent for that neighborhood, you know, am I still gonna be able to cover my debt service if that worst case scenario happened?
Yeah, basically it's all about looking at sort of the sensitivity analysis and just simply saying, okay, yeah, if rents were to drop by this, how does that impact me? And, you know, can I still pay my bills? And, you know, am I still gonna be made whole? You know, I know sometimes it looks like we're trying to make things complicated, but we're not. I mean, this is as basic and as simple as we can get it in terms of trying to understand this sort of thing. But it really just boils down to, I mean, one of my best friends who has been an extremely successful real estate investor, he, you know, looks at everything on such a basic level. It really does come down to, what is that rate of return I can get on an annual basis? Okay, what is my loan to the bank for? Okay, this is less than this. Makes sense? I'm gonna buy it and own it. You know, that's as simple as it gets. Okay? But, you know, he does take into consideration that, well, yeah, rents can, you know, get lower, you know, and things can happen, but, you know, on a very basic level, that's really all you have to do. Okay? All right. Okay. All right, now, let's see. All right, loan to value ratios. So basically, every lender, for the most part, wants you as the property investor, the property owner, to have some sort of skin in the game, okay? And all that means is they want you to have contributed some of your hard-earned money into whatever deal that it is that you're doing, because they feel like if you've got skin in the game, you're much less likely to just walk away, you know, toss them the keys and say, I'm out of here, okay? If you've got that sort of, you know, skin in the game, all right? Because here's the thing. With a lot of real estate loans, historically, you have had non-recourse notes versus recourse or full recourse notes. Let me explain what that means. A non-recourse note means that you can literally toss the lender the keys and say, I'm out of here. This project isn't working for me. And you can walk away pretty much that day, and there's not a thing they can do. They can't go chasing you down the street and try to get more money out of you because it's a non-recourse note, okay? That's a really important thing, okay? And so they can't come after any of your personal assets. They can't come after any other real estate assets. They can't, you know, they just can't, okay? They have to look exclusively to the property that you have financed with them to satisfy whatever debt is outstanding. Okay, does that make sense? So usually, given that kind of an environment historically, lenders then required a fairly substantial down payment, meaning that the normal standard was, for many, many years, 80% loan to value. Okay, meaning you, for commercial properties, you would put in 20%, they would finance 80%. Therefore, if you walked away, you were losing that 20% equity, and they got to keep it, okay? But over time, lenders have gotten a little bit more skittish about, these sorts of things because they've had some bad experiences. And so one of the very first things they do, sometimes even before they adjust the loan to value ratio, is they all of a sudden start using full recourse notes, okay? And what that means is now, in the event that for whatever reason you don't pay the bills, you don't actually pay your mortgage, they can come chasing you down the street, okay? They can potentially, depending on what the state that you live in, the laws associated with that state, they can potentially take possession of other assets that you may own, okay? So you have to be very, very careful, with those sort of recourse notes that they can, as I said, they can come chasing after you and potentially, take possession of cash, take possession of other assets, depending on what that state allows them to do. And every state's different, okay?
But technically, it's only if the property doesn't cover the 80%.
Right, but my point is, they have additional means to basically recover those funds, okay? And inherently within this, there's kind of a perverse incentive for the lender to sort of say, okay, I'm not really going to expend a lot of effort trying to get the maximum value for this property because I know that this person has deep pockets, so it's probably going to be easier for me just to go ahead and dump the property, get, a fraction of what it may be worth, and then go chase after the borrower because I know they've got deep pockets and I can just, potentially put a judgment against them. Okay. All right. Question, comment?
Especially if they're friends or investors.
Yeah.
That's what happens.
Okay, so this loan to value, every lender is different, but the standard, like I said, traditionally around 80%. But as we go through rough economic times, what tends to happen is that number gets lowered as the lender gets more skittish and goes down to, let's say, 75% or goes down to 70 or 60. And in some cases, when the market was really bad, I mean, I've seen some loans as low as a 40% loan to value. So that means that you've got to come up with a 40% loan to value ratio. What does that mean you're coming up with as a borrower? 60%. Okay, that's a lot of cash to come up with to do that deal. Okay, but the reason the lender's doing it is because they're scared to death that the market is so bad that if something does go horribly wrong, they don't want to be the ones that are going to be left holding the bag, an empty bag with no money in it. Okay, make sense? Okay. Now, what you do see, but not maybe quite to the extent that you do see on the downside, is that the market starts to really improve. The market is super hot, and there's tons of competition to get those loans made because everybody in town is loaning, and there's money. For commercial loans, I mean, 85% is kind of on the upper end. However, then there are special programs, especially for like multifamily residential, as it relates to like government programs, whether it's through HUD or whoever, that you may be able to get up to 90 or 95% loan to value on some of those deals. I haven't seen too many that are 100% loans, but weird things exist. Let's put it that way. Never say never. All right. But the point is just simply that the loan to value is not fixed from one lender to the next. Okay, that you literally can go from this lender that's located here to this lender that's located over here, 2 different loan to value ratios. Okay, and also another thing to put in the back of your mind is, when you think of lenders, most of you, the only thing you think about are those commercial banks sitting on the corners. You're thinking about Wells Fargo, you're thinking about Bank of America, you're thinking about whoever that's that normal, traditional kind of bricks and sticks kind of bank. That is not the only source of lending that is out there in the market. There are plenty of high net worth individuals or organizations that are willing to potentially loan money. Now, their terms are usually going to be considerably different, and they have a lot less restrictions as to what they can do or the creativeness that they can sort of employ whenever lending to you. But nonetheless, there's capital out there that's available to be borrowed, okay? So, you know, with those lenders, yeah, you might be able to juice up that loan to value a little bit higher, but then there could be this whole thing of, well, what sort of control do these folks, you know, take possession of whenever you get a loan from them? Okay, does that make sense? Okay, thoughts, comments, observations, yep.
When, it's kind of a weird question, so when you're halfway down paid on an asset, do you own it? Is it like a split dollar bill type thing? I know there's probably like a lien or some legal jargon that goes along with it. I paid half of it.
Let's put it this way. You
Don't
really don't own an asset, a real estate asset, until it is fully paid off. You can say, oh yeah, I own my house, you know, and I just got a 30-year mortgage on my house. You don't really own that house until that 30-year mortgage is paid off, okay? But people love to use that vernacular all the time because it somehow gives them comfort that they own that asset. But it's really no different than going down the street to the rent-to-own place and say, yeah, you know, here, give me that couch or give me that bed or whatever, and I'm going to make payments to you for the next, you know, 4 or 5 years, and then finally at the end of that 4 or 5 years, you hopefully own that bed that would have cost you $500 in the store, now you paid $5,000. So my point is ownership is an interesting thing. I mean, legally, yes, you can say that I own my house, but yet you have a lien against your property for this mortgage. Okay, but it's all legalese.
Right.
At the end of the day, you don't own it until you have paid the last payment. Okay, I don't know how more explicit I can be about that, because
Just making sure.
well, you do in the sense that you have many more property rights under those circumstances than you do just simply making those mortgage payments for the next, you know, 30
I was
years.
referring to satisfactory judgment.
Okay.
Somebody send you that
Right.
paper that says you own
Right,
that.
Don't you own the equities?
You own it.
Well, okay, you own the equity. Okay, yes, if you were to sell the house midway through, you could cash out, get some of, you know, the additional equity out. You can do the same thing with, obviously, a home equity loan, okay? But the point we're trying to get at is this whole psyche. Not so much with this generation, but with a couple of generations ago, like my parents' generation and you know, that sort of thing, where the whole idea of home ownership meant so much to that generation that it was this concept that, you know, I've got to have that 3-bedroom, 3-bath house with a white picket fence, big yard, a big white pickup truck, and a big golden retriever, you know, and 2.3 kids, you know, and that was, you know, the normal sort of, you know, standard for, you know, the country. And then
They cost $35,000.
yeah, but it was just a different mindset, and it was like looked down upon if you were a renter. Oh my God, that you should be a renter, because somehow that means that you're really not a part of this community. You really don't have anything invested. You're, you know, and so it's a fascinating concept. I mean, it was this whole mindset that, you know, Ryan brings up, you know, about home ownership. You know, it's a very sensitive topic for, you know, a lot of folks that, you know, do you own or do you rent, you know? And, but the reality is you really don't own it until that last payment. So you're really no different in one sense than the renters. You're still paying somebody, okay? But yet you supposedly have a few more rights, you know, to be able to, you know, do some things to the property if you know, want to. Yep.
Yeah, I'm from that culture back home. It's, if you've got the mortgage on the house, you've rented the money, and you might as well rent because you've also inherited all of the The
responsibilities.
responsibilities of proof goes bad, all that,
Yeah.
and you've rented the money.
Absolutely. Okay, moving forward. Debt coverage ratio. Okay. So, one of the things that a lender does also to kind of limit their exposure to a property and to the loan on a property is to set some sort of a debt coverage ratio. Now, if you remember, we've actually probably already talked about this formula a little bit, but the debt coverage ratio, also sometimes called the debt service coverage ratio, is simply the net operating income divided by the annual debt service on the property. Okay, does that make that bring the bells of okay, things that we've talked about? In other words, think of it like this. And once again, we've got our operating statement of potential gross income. We subtract out vacancy and collection losses. We add in other income that gives us effective gross income. We subtract out total operating expenses, which gives us net operating income. And then we subtract out annual debt service that gives us before tax cash flow. All right? So what we're really doing with the debt service coverage, oops, not the one I wanted to use. Try that again. Okay. So what we're doing with the debt service coverage ratio is we're just simply focusing on those two components of the income stream. We're focusing on the net operating income and the annual debt service. The lender is pretty much only concerned with, do you generate enough net operating income to be able to pay me? Okay? That's really what this whole ratio boils down to. That at the end of the day, the lender wants to make sure that you have more than sufficient net operating income to be able to pay them. So when you do the math, and let's say the math is we've got $10,000 of net operating income, and the lender has said, okay, well, that $10,000 of net operating income, we want to have a 20% cushion, okay? And that means you'd have a debt coverage ratio of 1.2, okay? So now all you've got to do to kind of back into the maximum annual debt service that they would allow you to have would be to take that $10,000 and divide it by 1.2, and you're going to get a maximum annual debt service of $8,333 and obviously 33 cents. Okay? Does that make sense to everybody? Yes or no? Yep.
Do lenders even touch like CapEx under the operating?
We're not going to talk about that right now. Okay? All right. So this is strictly looking at normal net operating income that the property generates each year, and this is what we're going to refer to from the lender's perspective as stabilized net operating income. All right? And so in this case, the maximum allowable annual debt service that the lender would allow you with a 1.2 debt coverage ratio would be $8,333 a year. Does that make sense, everybody? Yes or no? So all they're saying is they want a 20% cushion. That gives them a 20% cushion. Okay? Now, what's left over is just simply your before tax cash flow. We'll just go ahead and pop that. We don't really need it, but we'll just go ahead and pop it in just for fun. So $1,666 and let's say 67 cents. So another way to look at this is that your income could go down by as much as an additional $1,600 and the lender would still be paid. Does that make sense? That's how the lender's looking at it. That's the cushion that they want, that they know that by setting it at like a 20% cushion, hopefully that's enough. Now, once again, if you've got a relatively risky property type, if you're in a relatively strange, unpredictable sort of market, they can easily set that debt coverage ratio to be something substantially higher. I mean, let's say they raise it to 1.4, okay, to give themselves a 40% cushion. Well, doing the math on that, 10,000 divided by 1.4. Okay. So 10,000 divided by 1.4, yep, 7142.86. So obviously we'll just be replacing that number there, and then if we got our before tax cash flow, just to kind of put it in. 28, 57, 14. Okay, does that make sense?
Yeah. Because you're increasing the pad you want.
Yes. So by going from 1.2 to 1.4, that just means that the lender is going to be lending you less because the annual debt service is going to be less, but it's also going to be requiring you to well, in one sense, that you're going to have to be generating more income to be able to satisfy the cushion that they want, okay? Now, let's just sort of take this first one over here for a second.
Professor, what if you're quality buyer? I mean,
What, I'm sorry?
if you're someone that will control a lot of assets, you can always require the lender to, I mean,
Okay, so the question is, if you own a lot of assets, can you potentially negotiate this?
yes.
Okay, yes, potentially. And something, I think we talked about it maybe, whether it was this class or the other class, something called cross-collateralization, okay? Where you would pledge basically other properties that you own to this in the event of a default. So they might say, okay, you've got half a dozen other similar properties or whatever, we are going to allow you to cross-collateralize those and pledge those against this loan as well, so that if we're not able to get what we need to get out of this property, we can automatically go to those and get the money. So therefore, maybe instead of a 1.2, we might go down to a 1.1 or whatever it might be. Okay? But yes, it potentially could be negotiated under those circumstances. Okay, all right. So let's just take this 833333 as our maximum annual debt service that our lender will allow. Okay? What we want to be able to do is to say, all right, great, fine. How much of a loan are you going to give us? Okay? Well, what other variables would we need to know? Two variables.
Interest rate.
We need to know the interest rate and the term. In order to solve,
You're given 1.2.
for loan amount. Okay? Does that make sense? With that one piece of information, we would need those other two pieces of information to solve for the loan amount. So let's do it real quick. Okay? So first of all, 12 payments per year. And we're going to take the $8,333.33 divided by 12 to get a monthly debt service that we're going to put in as our payment amount. And we can put it in as a negative number, doesn't really matter. I mean, it's going to spit out a negative or a positive on the other side. And then we're going to put in our interest rate. Let's say 5% is an interest rate. And our term of, let's say, 15 years. And then to solve for the loan amount, so we solve for present value. Okay. So the monthly payment is going to be $694.44. 5% interest rate, 15-year term. 87,816, 11, probably off maybe a penny or two depending on rounding. Okay? Does that make sense, everybody? Yes or no? Okay? Now, this is the maximum loan amount. That's not the purchase price of the property. That's the maximum loan amount on the property. So, if that's the maximum loan amount, right up here, maximum loan amount is equal to $87,816.11, and we have a maximum loan-to-value ratio equal to 80%. What is our, basically, not maximum, but what is our property value? Or we call it the implied property value.
105.
Okay? So all you're going to do is take basically the 87,816.11 divided by 80%, and you should get 109,770 and some change would be the implied value of the property. Okay? Does that make sense? What we're doing is basically back solving, which is really important to be able to do. It's not complicated, but it's something you need to inherently always begin to think about. Is that you're given a few key pieces of information, take that information and turn it into something useful, and in this case, giving us what our implied property value is. So, assuming that this is our implied property value from the details that were given by the lender and the income that we're supposedly going to generate on the property and so forth, so on, if we find a property in the marketplace and the asking price of the property is, let's say, $125,000, does it probably make sense for us to do this deal? Probably not, okay? Because we're saying we really probably shouldn't be paying more than $109,000 for the property, okay? If we're going to satisfy all the other conditions that we've got. Now, we could pay $125,000 for the property, but that's going to mean we're going to put in more equity, okay, that we may not want to do, okay? But what if the property, the asking price is $100,000? Then we're going to say, woohoo, wait a second, you know, we could probably do this deal, and given this implied value, this makes a lot of sense for us. Okay? Does that make sense? You're just trying to get a reasonable gut feel for what that value should be. Okay, somebody had a question back here. I don't care which one. Flip a coin.
When you're calculating, like doing all these calculations, and you get to the closing table, and then you get all these loan fees and everything adds up, how do you calculate those?
Well, you need to know what they are up front. I mean, they will disclose that information to you. It's not an issue they're not going to disclose it to you, but in many cases they, you know,
seems like at the end, it's like,
at the end, yeah, no, at the end, you know, it's like, yeah, okay, whenever everything is finally said and done, here are all the fees, all the closing costs, and so what most people tend to do is after they've been through a couple of those kind of transactions, is they try to get a rough estimate of what those closing costs are going to be. And so they might, you know, just determine that over time, on most transactions, the closing cost might be, let's say, 8%. And then use that as a, you know, a foundation for, you know, whatever, you know, deal it is that they're doing. You know, to say, okay, we got to take into account, you know, let's say brokerage fees, we got to take into account attorney fees, or we got to take into account, you know, recording the deed with the county. We've got to take, you know, courier fee, you know, whatever. But, you know, but try to come up with some sort of a, you know, standard. Now, what tends to happen in some cases is some folks obviously do try to whittle away as much as they can off of those, you know, sort of fees, because they know they're going to be facing them, and they don't want to have to pay any more than they absolutely have to, and they can sometimes think of creative solutions to maybe, you know, get around those, or have the other party pay for them, or whatever it might be. So, Okay, moving forward. Other questions? Brian, did you have one?
Would you finance, if it was a $100,000 property, would you finance, or would you put down the,
Okay, the difference between the two?
yeah,
So you're basically, the difference between 109 and 87
yeah.
would be the equity that you would have to put into this deal.
Would you max out the LTV ratio? Just personal question. Is that something that you like?
It totally depends on what you're trying to achieve. You know, in some cases, yes, you would, you know, because you're saying, okay, I want to squeeze every last dollar I can get out of that lender, you know, to help me with this deal so that I don't have to put in any more of my own money than I absolutely have to, because I want to keep that other cash money maybe available for unexpected things that might pop up that, you know, after you've owned the property for a couple of months or whatever, that all of a sudden you realize, oh my gosh, there's a lot of unexpected, you know, fees and charges and expenses that I wasn't really anticipating, and you're not going to find it very easy to go back to the lender to get, you know, additional money to sort of help you out with those things. And so it's probably one of the most common things that happens to, you know, first time, you know, sort of investors is they get in way over their head with this sort of stuff. They say, oh yeah, I can afford the monthly payment. Oh yeah, I can afford, you know, the insurance or whatever. Then they get into it, oh, I didn't realize property taxes were that high. Oh, I didn't realize I had to do all these other sort of maintenance and repairs or to pay for all these HOA fees or, you know, whatever it is. Okay? All right, moving on. All right. So far, so good. Okay. See that sugar high that you got off of the donuts is now starting to wear off, isn't it? All right, moving forward. Okay, equity participation loans. All right. Every so often, you will run into lenders, especially non-traditional lenders, that are willing to give you basically maybe a special deal or special arrangement if they can have some sort of piece in the pie or piece of the pie of the deal. But what they are basically saying that they want to be able to do is to participate in the upside of the property, okay? But if it does well, you know, they win, okay? You're gonna win, but they're gonna win, okay? If the property does well in value. And you also need to think about this, once again, this whole chapter to a certain extent is about a lot of non-traditional lending stuff, okay? And so you're not necessarily, once again, talking about your traditional banks. We're talking about other partners, other lenders that you may have available to you that are willing to get involved in the loan. So, as an example, you may have a situation of where someone is willing to give you a low interest rate with a high loan-to-value loan, okay? And you're saying, awesome, you know, what better of a deal can I get than to get a nice low interest rate loan with a high loan-to-value, okay? Because that means you're putting in very little of your own money into the deal. But the trade-off, in this particular case, beyond the financial that we're going to talk about, may also be, as I sort of said, they may want some sort of control in the deal. They may want to be able to constantly look over your shoulder that every time you write a check, they want control of you, of whatever checks that you're writing, whatever expenses that you have. Every time that you get a new tenant, they want to see the details on that tenant as to how good that tenant is, okay? So it may not be for nothing, but on the flip side, on the financial side, what they want from you to give you this low interest rate with a high loan to value is they want a piece of your annual NOI and a piece of your reversion. Does that make sense? So in other words, in addition, so giving you this low interest rate with a high LTV, they want a piece of your annual net operating income, and they also want a piece of the reversion whenever you either sell the property or you have the property valued at the end of some sort of predetermined period like 5 years. Okay?
So you get the benefits of property management without having to do the legwork of it.
I wouldn't quite go, I understand what you're saying, that if I'm saying, okay, the lender has all this additional oversight and whatever, but it's usually only on the financial things.
No, I'm talking about, like, you know, the 20 and 2 standard property management. If you're describing that, if they're participating in both the equity and the annual NOI, but they're not having to manage it.
Right, okay, from the lender's perspective.
Yeah.
Yes, okay, I see what you're saying, okay.
That's a problem.
Okay, so let's just sort of see how we might set this up. All right, so let's say that we've got $1 million property. All right, and what's the low interest rate that we're going to charge these folks? 4%?
2%.
2%. I like 2%. 2%. Okay, and this once again, 12 payments per year. And let's do it over 15 years. Okay, so let's just start off with this. Okay? So that would be our monthly payment. Okay? Nothing new, okay? Nothing, that's our monthly payment. All right? Now, let's say that if we go over here and we do all the stuff that we just sort of talked about, you know, potential gross income, you know, subtracting out our vacancy and collection losses, adding in our other income, giving us EGI, subtract out operating expenses to give us net operating income, subtract out annual debt service to give us before tax cash flow. Okay? So what we're saying is this number times 12 is going to be $77,221. That will be our annual debt service. Okay? Does that make sense? All right? Now, let's assume that our NOI is $125,000. Now, I'm just picking that number totally out of the air, okay? So our NOI is $125,000. So that means we'd have $47,778. Okay, that's some change, okay, as a before tax cash flow. All right. So I've given you the $125,000, but everything else, obviously, you're able to calculate. Now, so, what percentage of your annual net operating income do you want as this equity participation lender? 50%. Okay, 50% of what? The total NOI? A piece of the NOI?
After the before tax cash flow.
Well, we're probably going to run it off of the NOI, even though I understand where you're going with that, but since we're saying it's off of the NOI, we're going to base it off the NOI. So what we might say is we want a certain percentage above and beyond a baseline. Okay? The baseline might be $100,000. So anything above and beyond $100,000, we get 50%, okay? So here's what we're getting. We're getting 50% of NOI above a base of 100,000. Does that make sense, everybody? So in this case, how much does that lender get? Well, 25,000 or 125,000 minus 100,000 would be 25,000. They get 50% of that, which would be 12,500. Okay? So the piece that they get each year would be 12,500. Does that make sense? Okay? So all we're doing to get that is to make sure, those of you that are following along, you're taking the 125,000 minus 100,000, which gives us 25,000 divided by 2. Okay? 4 times 0.5, either way.
So it's a lender's percentage, right?
It is their participation in the equity, or in this case, I'm sorry, their participation in the NOI, the income the property is generating. That's why it's called an equity participation loan, is because they, in essence, are participating in the equity being generated by the property, not only in terms of operating income, but also the residual income. Okay. Now, at the end of, let's say, 5 years, at the end of 5 years, we need to establish a value for this property, all right? And so we are simply going to use, give me the cap rate. 6%. 6% cap rate, all right, on the $125,000 of NOI, okay, to come up with, or to establish, sale price. Okay, so all we're going to be doing is taking 125,000 divided by 0.06. $2,083,333 would be the sale price at the end of 5 years, based on that cap rate. Okay? Does that make sense, everybody? Yes or no? Okay? Now we're doing all this on a before tax basis on purpose to keep it simple. All right. So, as we said, the lender is also going to get a piece of your reversion value. So that's what we're working on now. All right? So, of the reversion value, what percentage do we want to give them? Well, not what we want to give them, what percentage do they want?
10? I think 10 sounds good.
50?
Let's go with something in between. Let's say 25%. All right. So lender, oops, yellow. Lender requires 25% of reversion value above initial sale price or purchase price, maybe better terminology. Okay, All right, so this particular property, let's look back, oops, all right. So in this one, all we know about is the original loan amount. We don't know that that was the purchase price, okay? So we could say, no, the purchase price was something greater than that. Let's say the purchase price was 1.5 million, okay? So initial purchase price was 1.5 million, let's say. But just to make sure everybody's comfortable, initial loan amount was equal to 1 million. Meaning initial equity amount would be 500,000, okay? Is everybody cool with that? Yes or no? Okay, now, what this lender is saying they want is they want 25% of the reversion value above the initial purchase price. So that means sale price at end of year 5 is equal to the 2,083,000, and then we're going to subtract out the initial purchase price of 1.5 million. Okay. That means a 500, yeah, I want to, oops, yeah, 583,333 capital gain. All right, and this lender wants 25% of that. Should be 145,833. Okay, so this would be the lender participation payment. Okay? Does that make sense? Yeah? That's the first part of the problem. Okay. The second part, go ahead.
So when you're paying off the lender in the participation aspect, not in the interest.
I'm sorry, I couldn't hear you. What?
When you're paying the lender in the participation aspect before taxes, do you use that as an expense or is it like an interest expense?
You would look at it, in essence, it's to a certain extent, it is a payment as if you were making it to an investor. Because that's really what it is. Okay? But we're doing it all on a before tax basis. Okay? All right. So let's take a look at what this actually then translates into. From the lender's point of view. Okay? From the lender's point of view, at time period 0, what are they getting you? A loan for $1 million. Okay? And we'll go ahead, we can do this, we can do it monthly, we can do it annual, and we'll go ahead and do it monthly. Go ahead. All right, 12 payments per year. All right, so that is going to be our initial cash outflow from the lender's perspective. Okay, in month 1 through month 60, okay, well actually month 59, what is the lender going to receive? They are going to receive their monthly payment $64,3509. Okay? Now, they're also going to receive 1/12 of whatever the NOI number was, if we're gonna do this on a monthly basis. And that NOI number that they were scheduled to receive, say 12,500. So we take the 12,000, I'm just gonna put it up here, 12,500 divided by 12. Okay, whatever that is, all right? And then that number is going to be the cash flow that they received that first 59 months. Does that make sense?
Is that 12.5, that was half of anything above 100,000?
Correct. Yep. Yes, that's why we're dividing it by 12. Yep. Okay? All right. Then for month 60, okay, on this deal, they are going to get, the lender is going to get the $145,833 and whatever the change is, plus, what else are they gonna get?
6,435.
What, I'm sorry?
One more payment.
Payment and
Well, they're gonna get the payment, yes. I'll just go ahead and write it down, I don't wanna confuse anybody. Okay.
Plus the loan balance.
Plus the loan balance. Okay, which we still have to calculate. All right, let's see where we put that number in here. 643509 plus 12,500 divided by 12. 509. So 74, 76, 76 is basically just what's above here. Okay? Plus the mortgage balance, and then that's going to be the final cash flow, and then you're going to solve for internal rate of return, and then that's going to give us the effective cost of borrowing from the lender's perspective. Does that make sense? Okay, so now we need to go back up and we need to figure out what the balance is on the loan. Okay, so we just go back up to the original details of the loan, and just find the balance at the end of 60 months. Okay, so our balance, 699,363.71. Okay. All right, so now we should be able to put all that in and then solve. Okay. Okay, looks like we get 6.33. Okay? Pretty straightforward.
So that's your effective rate of borrowing.
That would be the rate of return that the lender would receive off of this deal. Okay? So their stated interest rate is what? 2%. What they're really getting off of this deal is 6.33%. Okay? So chances are, you might have been just better off going to another lender
Just getting the money.
and getting the money.
And that 699 is the balance on the loan at month 60.
Correct. Correct. Okay?
Can you do the 1 through 59 on the CFJ? How do you plug that in?
Okay. 852, 673, 47 as a cash flow, and then you solve for internal rate of return. Okay? All it was just combine everything from up above. Okay? Any questions?
That, when you write the 1 to 59 and then 60, that's the amortization? That's not amortization.
No, okay. Well, this is just simply saying you are paying 74, 76, 76 for 59 months. Okay? And that is just simply the 64,3909 plus the 12,500 divided by 12. Okay?
You're just saying what that area.
Yep. And then down here, so that's saying that occurs for 59 times. And then your final payment in month 60 is the combination of the 145,833 plus the final payment of the 7476 plus the outstanding balance of the 699,363, which equals the 852,673. Okay? All right?
I had a question for you. If you go back up. Sorry, guys. So the capital gains for tax treatment?
Don't, this is not a tax treatment issue. That's separate. Trust me. That's for investment class.
Okay, so we'll get that later.
And the balance of the loan, you got it by?
One input 60, shift, amortize equally.
Could you do 60, 60, 60?
Okay. You could get the balance.
Off of the 1 million.
Right. In other words, all you're doing, I'm a little disappointed that you guys are asking some of these questions because we have done some of this stuff so many times, you really should know this by now, like by heart. Okay, so to get the loan balance, all you're doing is just putting in the basic loan information, and then you're doing one input 60, shift, amortize, equal, equal, equal. Okay? And that's going to give you whatever the loan balance is. Yeah? All right. Move forward. Oh.
That's
Right to the bottom. All the way to the bottom.
Do you see this very often?
Well, in certain instances, this happens all the time whenever you're doing basically a joint venture with somebody.
Sure. Yeah.
That's what I'm saying. Don't think of a lender as being a lender. Think of a lender as being someone you're basically joint venturing with. Okay, let's move on.
Can you up a little bit? I'll take a picture. More. There. Thank you. That's it.
So they go pro rata. The pro rata share on
Okay? Still $1 million.
Hold it forward, I can't do that one in my head.
Okay, we need to move on. Let's go. All right. Okay. So one of the things that we've talked about a little bit is the whole idea of a sale leaseback. All right. And as I said, the example that I gave, and obviously I think even showed you an example, is things like CVS, Walgreens, but they're not the only folks that have used sale leasebacks. This happens all the time with corporate sort of tenants or corporate owners of corporate real estate. That they say, hey, we're paying so much money, in a mortgage payment on this, and we're not really in the real estate business. Why do we need to own all this real estate? The value could be fluctuating over time. We have this corporate campus. Maybe we should sell it off and then just fix our cash flows at a certain dollar amount for the next 25, 30 years and call it a day, okay? So this, pretty much whenever these originated was probably about 30 or so years ago. Was whenever they were, and began to be super popular because it was an easy way for corporate owners of real estate to divest themselves of these huge portfolios that they had acquired over time because they all thought owning the real estate made so much sense. But they began to kind of realize maybe not so much because of some of the risk affiliated with that. But with the sale leaseback, it gave them the ability to be able to lease the property back at a fixed cost for, as long as they pretty much would want. So, using kind of the simple example that we've kind of used before, we maybe have a developer or a corporate customer, they come in, they buy and develop a property for, let's say, $7.5 million, all right? Ultimately, after having been developed, they sell it off to some sort of institutional player, some sort of high net worth individual, whatever, for $10 million. And maybe under those circumstances, they get a lease that's based on like a 5% interest rate for, let's say, 30 years, which is almost like a loan, but that means that their payment on this would be like $53,682.16 per month. And we're going to say this is their lease payment. Okay? But the lease payment, as I said, it's going to be for 30 years, it's going to be fixed, and it's going to be based on the new value of the $10 million over what their original development costs were, $7.5 million. Okay, is everybody cool with that? Yes or no?
Yeah, very cool.
Okay, now.
That's monthly payment.
Monthly. Okay? Now, a very simple question that I could ask you to follow up the more complicated question that I just previously asked you, and the other question would be, all right, how many months can they operate without basically having to come up with a mortgage payment or come up with a lease payment?
Depends what their discount rate is.
No, we're going to keep it very simple. We're going to say, how many months can they operate without having to make a mortgage or a lease payment?
10 million divided by...
No.
Well,
Well, I thought it was an easy question.
2.5 million.
Okay.
2.5 million.
2.5 million
Divided by 53,682.
divided by 53, 682, 16. So basically 46.57 months. That's not bad. That's almost 4 years that they could operate this property without ever having to pay any lease payment. Okay, so you think about like a CVS or a Walgreens or whatever, that's a heck of a deal. Okay, so that way, all money then being generated by that store can pretty much, be back in the corporate coffers and be used for whatever it needs to. But see, that's also making the assumption that there's no time value of money really involved with this either. That, they could have taken that 2.5 million, stuck it in the bank, or stuck it into some sort of a savings account that was maybe earning, some level of interest, and, therefore their monthly payment would be, yeah, all things considered. Okay? Makes sense.
Could cost more.
I'm sorry?
If you put it into like short-term equities, bonds, and stuff like that, you could drive a decent net working capital stuff.
Okay. All right. Questions? Okay. Moving forward. All righty, Ruben. Okay, another sort of interest-only sort of loan question. All right, this also happens to be covered a little bit in this chapter, so we're going to bring it up again. So in this case, okay, how big of a loan do we have? Let's say $5 million. What sort of interest rate? 4% interest rate. Okay. Based on those two pieces of information, what is my first month's payment?
5 million.
No. 5 million is the loan amount. Okay, the question is, what is my first monthly payment?
$16,666.
Okay, let's see. Okay, first of all, the first thing that should not pop in your head is, what is the term? It's irrelevant. Term is irrelevant. If it was a 1-year term, 50-year term, doesn't matter. You're still going to be making, monthly payments, okay? So, in this case, what you're going to be doing is you're going to be taking that $5 million, multiplying it by 4%, which gives you, oops, hello, that's not right. 5 million times 0.04, okay, 200,000. And that would be your interest per year. But we need to divide that by 12. So your initial monthly payment would be $16,666.67. Okay, make sense? Okay, moving forward. Any questions? All right, next topic, accrual loans. All right, this is where we have two different rates. We have a pay rate of interest, and we have an accrual rate of interest. Normally, well, pretty much all the time, your accrual rate is going to be higher than your pay rate. I'll explain this here just in a second. So let's just say, give me a rate for the pay rate.
4%.
4%, and the accrual rate is, let's say, maybe it's 8%. So double that. All right, so what this means, for those of you that are really thinking about this, you're going to see a similarity to something we've already covered. Okay, and we'll get to that here in a second. So the way this works, I borrow however much money I borrow, and the lender simply says, you're going to pay me an interest rate of 4%. But I'm doing that because I'm super nice, okay? But your actual balance is going to accrue at a rate of 8%. So it basically pretty much means you're going to have our good friend negative amortization occur, okay? But the lender does this because it looks like a sweetheart deal to you as the customer, because they're telling you, oh, you're going to be paying 4%, but the reality is you're really being charged 8%. Okay? Thus the reason for the term accrual. Okay? All right. One more way for the lender to take advantage of people. All right. So, how would we do this? All right. So let's just say we set this up as 12 payments per year. We put in $100,000 as the loan amount. And what term do we want to use? It doesn't really matter. 10 years. And our pay rate is going to be this 4%. So the first thing you're going to do is you're going to calculate the payment based on the pay rate. Okay? We all good with that? Okay. Now, this next part is mission critical that you do it correctly. Now what you're going to do is you're going to put in 8% as the interest rate. But, and this is a big but, what you do next is critically important. Okay? You are not going to resolve for the payment. Okay? The payment is staying fixed at the 10/12/45. So what you are now telling the calculator to do is to now set the interest rate from 4% to 8%. So from this point, whenever it calculates the amortization, it's applying the 8% rate. Okay? So, in so doing, we now, let's say, want to find out what the balance is. Let's just say after the first 12 months. Okay. And it's 95,000. 695 in 01, round. Okay, is everybody good with that? Yes or no? Now, let's just, okay, so that is the answer to the question. What would, let's say, be the balance of the loan at the end of some period of time, okay? All right, now what I want you to do is to put your calculator down for a second. Let me do the math up here so you just sort of get this in your head of what's actually happening. So, under these circumstances, if we had stopped right here and we had put in 1 input, 12, shift, amortize, equal, 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 let's see what would have happened. Once again, let me do it. If you don't do it, because I'm not going to ask you to do this. I just want you to see the difference. Okay, so the balance would have been $91,699.50. So what we're saying, this is a lesson that I'm trying to convey. The answer is the bottom one. This would have been if we had made those payments of the 10/12/45 for 12 months and it had both paid and accrued at 4%. Our balance would have been this at the end of the first year. But because it's actually accruing at 8%, and we're only making payments based on 4%, that balance is obviously much greater. I mean, we owe more money than we would have owed under the circumstance. Does that make sense, everybody? Yes or no? Okay.
So when does this typically make sense for?
It makes sense whenever the lender is selling it as you're getting this sweetheart deal of this 4% up front, and then they're just simply kind of glossing over the fact that you've got this 8% accrual rate.
So they don't really show it.
They can show it, but once again, so many people, you just have to understand, I mean, I'm not saying you don't, but you have to understand how many gullible people,
Right.
there are as it relates to anything, whenever it comes to numbers and financial sort of pitches that are being offered. I mean, it's beyond almost comprehension, okay?
Because I can't see how, even just from looking at it I've never seen this kind of loan until now. I mean, I've heard
See,
of this.
the lenders automatically do this all the time whenever they have what's called lender forbearance, which is basically pretty much agreeing to lower your interest rate, but yet they keep the accrual rate, so you're still going to owe them the interest, but they're just saying, we're going to ease off on the payments.
Right.
It's like the portion that we see when the lender allow you to make a lower payment, and then because of a hardship of something, and then at the end the balance increases.
Okay, all right. Thoughts, questions, observations?
Thank you.
Okay, lesson number 39, how not to be taken advantage of by the lender, okay? All right.
What would this look like when if someone offered you a loan like this? What would it?
Well, they would simply show you, yeah, here is the rate. I mean, it's going to be embedded in legalese.
Yeah.
So someone like Dara over here is going to be drafting up this document that's going to show that the original interest rate is 4%, and then the accrual rate is going to be 8%, all embedded within, once again, some sort of loan document, and then you're simply going to sign it, and that's the way it's going
So
to be.
they sell you on the payment.
Yes.
Gotcha.
The fine print says.
Makes sense.
Well, I mean, many years ago, just kind of give another quickie sort of example of something somewhat related. Many credit cards, many different retail vendors would say 0 interest, 0 payments for 12 months, let's say. But what would typically happen is if you didn't read the fine print was 0 payments, 0 interest for 12 months, but if you didn't make full and complete payments by the end of that 12-month period, you will get charged retroactive interest for that year. Typically it's something like 24%. Okay? So they took advantage of the people who didn't read the fine print, and so you got $10,000 worth of furniture, at the beginning of the year, and you're thinking, woohoo, 0 payments, 0 interest for 1 full year, and then I start making my payments. No, it's, if you don't make that payment by, let's say, December 31st that first year, then you're going to get charged, let's say, 21% interest. So all of a sudden that $10,000 furniture that you got, that you thought was such a great deal, really cost you $10,210. Okay, does that make sense? All right, moving on. $12,100.
Yeah.
Okay, moving forward. Okay. Convertible mortgages. All right. Very simply put, a convertible mortgage is where a lender has the ability to convert the mortgage that they have on your property into an equity position. Does that make sense, everybody? So in other words, it's exactly what we were saying earlier, that you asked the question of, well, what is the lender's basis in the property, in this like equity participation loan? Well, what we're saying in that case was like $1 million. So all we're saying here is the lender has a choice within a convertible mortgage to be able to convert that mortgage interest they have into an equity interest. So instead of them just being a debt holder, now they can become an equity holder as well. Meaning that whenever they do that conversion, they potentially are going to have all the rights, responsibilities, and everything else that the equity players have. Okay?
But there has to be like a trigger to it?
It depends. Once again, use your imagination. Okay? It could be a situation of where the lender does it just whenever they want. It can also be triggered by what if that your occupancy rate on this property goes down below 80%, automatically triggered, the lender says, okay, I'm going to become an equity player now, I'm going to take control of this property and make sure it doesn't go under. Okay?
So it's usually when there's issues, not when like, oh, now the property gets
Okay,
valued.
well, once again, you've got to look at this. Not just creatively, but you've also got to look at it. It's not your Wells Fargos that are doing this sort of stuff. Okay? This will be like you're borrowing money from me. Okay? You know, and I'm gonna loan you $10 million. All right? But I'm gonna put all kinds of things in there to protect me as the investor in this. As long as everything is maybe going smoothly, I'm staying out of it. Okay? I don't want to be bothered. Okay? But if something all of a sudden potentially throws up, you know, my radar and I'm seeing danger in the future, then I'm going to exercise my interest to basically convert this mortgage over into an equity position so that I can take control.
Have you seen this?
Oh, absolutely. I mean, think about it, once again, this is much the same way. You think about joint venturing with like high-tech companies.
Right.
Happens all the time. You know, I mean, all you have to do is watch a show like Silicon Valley, and you see this happening all the time. It's exactly what's going on. It's like, who has control, you know, over, you know, what is really taking place. You know, a company you built with your bare hands and brain, all of a sudden gets taken over by a bunch of people with a lot of money. Okay?
Is there equity in the property, like it's a 1-to-1 ratio, or does it?
It's going to be predetermined based upon whatever the loan documents say.
So then it could be, you could have it in there to ride appreciation as well.
Right. Precisely.
That's
Okay? All right, moving forward.
Basically got the
If
price.
you want more, give me more. Oh, that's okay. 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 Last topic for the quiz. All right, mezzanine loans. And we talked a little bit about this previously. And mezzanine loans are simply kind of a middle ground sort of loan. And I think we even went so far as to kind of even draw up sort of like capital stacks and things like that, and sort of say, okay, you know, maybe the normal loan where we've got 80% debt, 20% equity, now begins to look more like maybe 10% equity on top of maybe 20% mezzanine on top of 70% debt, okay? So the mezz piece is simply a middle piece, okay? It can be sort of debt, it can sort of be equity. It's kind of a hybrid piece, and I think that the terminology that I used in my explanation previously was, it's kind of like preferred equity, okay? In the sense of finance talk, okay? Now, all this means is that it may being the operative word, allow you to put in less of your own money, okay? Going from 20% of your own money in the deal to only having to put in half of that. But, and to not borrow as much maybe from the traditional lender. And so now you're borrowing, you know, from the mezz lender 20%. But usually the mezz lender, their interest rate is going to be higher than that, substantially higher than of that of the traditional debt. So you might have a situation, let's just say that the cost of debt is 5%. Okay? And the rate of return that you want under equity is, let's say, 25%. And then the mezz player, they might be somewhere sort of in between. They want a 15% return. Okay? Now, you would need to find out kind of what is your effective cost of borrowing on this, or what is, I mean, because you can sort of look at this in a couple different ways. One would be to just say what your effective cost of borrowing, which would be to lump the mezz and the debt piece together, or you could also say what is the overall weighted average cost of capital, which is to combine, in essence, equity, mezz, and debt. Okay, depends on what sort of looking for. But let's just say that we take our weighted average cost of capital, which is pretty much the little formula we did this morning in the very first example, where we've got overall sort of weighted average cost of capital or rate of return that we need. And here, we're adding one more, unfortunately. Okay, so what it's going to look like over here is our debt, our loan to value is 70%, our mezzanine is 20%, and then our equity is 10%. Okay, so those three added up together is what? 100%. Okay, what we're doing is kind of expanding it by one other player, which in this case happens to be the mezz player. All right. Now, our cost of debt, we're saying is, whoops, 5%. Okay. Our cost of mezz is 15%. And our required return on equity is 25%. Okay? So all we're going to do now, just like we had done earlier, basically do the math, in this case on all three of these, add them together, and that gives us our overall weighted average cost of capital. Okay, so let's start with that. Okay, overall is going to be 9% as our weighted average cost of capital for the deal as a whole. Does that make sense, everybody? Yes or no? Yes. Okay. Now, if I just were to ask you to tell me what the cost of the debt and the mezz piece is, okay, then that would only be, whoops, using the right pen. It would be these two, okay, only. Okay, so there, what you're going to do, okay, if I were to ask you, instead of the overall weighted average cost of capital, if I were to just simply ask you, what is your total cost of financing or total cost of borrowing, it's going to be these two combined. You're not going to include your equity. Okay? Much the same way that whenever we were talking about, you know, incremental cost of borrowing and others, you know, where you've got two different sources of potential, you know, capital. That's all we're doing here is just sort of isolating those. Oops. Okay, so for those, cost of borrowing, okay, you're simply going to take 70%, okay, times, in this case, 5%, plus 20% times the 15%. So you get 6.5%.
Which is minus like the equity.
Right. Now we can probably tinker around with this in other ways, but this should be sufficient. Okay. Any questions? All right. All right. So that leaves us a little bit of time now to talk about your project. Okay. Warm up here a little bit. I'm going to move the camera to take advantage of that. Okay, I sent everybody a spreadsheet this morning. And what this spreadsheet is, some of you may have seen this before. This is kind of a promulgated cash flow analysis software input sheet for CCIM, one of the big professional associations. And what this spreadsheet does is pretty much pulls in a lot of the stuff, if not almost all the stuff, that we have done in terms of getting sort of background information on a property and putting it into a spreadsheet that just literally gives you the answers that you're sort of looking for. Okay. There's a method to my madness on this, so make sure that you pay attention to what we're talking about. I'm going to make this as straightforward as I can possibly make it. All right? If you remember, what I told you that your project in this class was going to be was you taking raw financial output data and making it look as nice as you possibly can into a standardized format to be able to be presented. Do you remember that? Yes. Okay. All right. You've slept since then, but yeah. Okay. So what this model does, and the specific inputs of it aren't important per se, other than what it does is it gives you all the assumptions for this little property, and then it has, down here at the very bottom, you have one page that's sort of input page, and then the next page is a cash flows page. It gives you basically all the information that we have done in terms of potential gross income, effective gross income, all that sort of stuff. The fact that you can see this or not see this is actually part of the problem, okay? So you look at that, how many of you can read every single thing that's up there? Any of you? Okay, you can, you've got good eyes. Okay, the rest of us probably not, all right? And this is the problem that I run into every year when we run the competition course. I'm sitting on the back row on purpose. I can't see the numbers up there, okay? So those numbers are basically useless to me, all right? So let me just kind of fast forward here just a little bit. Then we have the cash flow for the sale of the property. Once again, more numbers I can't see, all right? Then in this one, they at least blow up a couple of things you can sort of have a better chance of seeing, which would be your before tax and after tax internal rates of return and net present value. But you still can't read all of these different ratios, back there on the back row. Okay, I'm leading up to the point here. So, what I am wanting you to do is I'm wanting you to design a set of PowerPoint slides. Not Excel slides, PowerPoint slides. That, in essence, are going to take the key, relevant, salient pieces of information from all of this and populate those PowerPoint slides. Now that sounds really simple, but what it needs to be is, and so it's okay that it's hard-coded, Now, it'd be great if you could figure out a way to, whatever this populates, it automatically populates the beautiful PowerPoint slides. That would be amazing, okay? But barring that, what we're trying to achieve is consistency, conformity in terms of the appearance and the output. So that whenever we ask you to do this competition project, you know, next semester or in the summer or whenever you're taking development 2, we want to be able to sort of assume that every single person is using the same output, okay? That they're delivering the same imagery. So on the financial side of things, we're all getting the same picture. And so what we'll do is that I'm going to pick, or we may even vote together, who did the best job in the class of doing this, and that's going to become our new standard in terms of the output that we want for the competition project. Does that make sense? Now, I understand not one size is going to fit all in every single possible scenario. I get that. But at a minimum, what we're talking about here is, you know, your PowerPoint slides, and we probably have to limit the number, no more than 10, okay? Because I don't want this to be like, you know, you've got 30 PowerPoint slides, but all you're doing is just blowing up each component of this. No, what we're wanting you to do is to sort of consolidate down and say, what are the key pieces of information here, okay? You don't need to know every little intricate detail. We need to know the key relevant pieces. Well, what do you think the key relevant pieces are? What your income is, what your expenses are, what your cost of debt is, what kind of debt you have, you know, what are basically your cash flows before tax and after tax, what are your rates of return, you know, those kind of assumptions. So that it's literally, you can still print this stuff off and put it into a bound copy of your report, but what we're asking for is that hopefully you guys creatively can come up with some synergies of figuring out how to best present this data to be effective. The value of this to you is for you to be able to think about it like this. If you go into a lender and you're just sort of throwing up these kind of overly detailed sort of spreadsheets, they're going to pretty much throw you out of the room, okay? They want the backup, don't get me wrong, but they want something that they can easily look at and say, okay, I get it, makes sense, let's move on. You know, do you follow me on this?
Well, if you went into an investor, you want to simplify it and give them that package to let them read it, and that way you can get in and out and not
Elevator pitch.
yeah.
So that's all I'm asking you to do. Maximum of 10 PowerPoint slides, and you're having to summarize all of the, what you deem to be relevant pieces of information in those slides from the spreadsheet that I sent you. Does that make sense, everybody? Now, if I recall, I said that we could do this as like a 2-person group. Is that okay? Yeah. Or do you want to do it individually?
No.
Okay, well, hold on. You are going to be given the option of doing it individually or as a 2-person group, no larger than 2. Okay? This is not going to be the sort of thing where you're going to pawn it off on somebody else. Okay? Let me make sure that's very clear. All right? So, at the most, a 2-person group, if you feel rock solid in what you're doing and how you want to do it, please, do it on your own. Okay? Now, as far as pairing up, what we can do, I can just quickly, okay, first of all, let's eliminate all the 1-person groups. How many people want to do it on their own solo? Okay, only Woody? Okay, okay. Oh, no, let's keep your hands up for a second. All right, so basically 1, 2, 3, 4, 5, 6, 7, 8 people want to do it solo. Okay, so remove those 8 people. Okay, the rest of you obviously are doing it as a group. So you need to identify a partner, and you need to identify them today, okay, in terms of who that partner is going to be, and get it done, all right? I don't care who it is, don't need to know. All I'm saying is, if you don't identify a partner, you're on your own, okay? It's as simple as that.
This is not good. This is separate from our project property, right?
This has nothing, this is a different class.
You're like 2 hours in.
I'm mixing them together.
Okay. Okay. Is everybody clear what the assignment is?
Can you run through like this sheet as an example? What what you would highlight.
Well, it's not so much what I would highlight, it's what you would think would be important. I mean,
And you
like,
want us to use just this sheet, correct?
the reason, okay, the reason I am saying use this particular spreadsheet is it's pretty comprehensive in what it will allow, okay? In terms of the flexibility of it, in terms of the inputs and the outputs, okay? The challenges are, it doesn't make for a good visual presentation to a prospective investor or lender, okay? And so you need to figure out, once again, what's relevant, what's not relevant on it. I mean, clearly, okay, look, use your brains, all right? Purchase price, that's gonna be a relevant piece of information, okay? You know, interest rate's gonna be a relevant piece of information, you know. Rates of return are gonna be relevant pieces of information. Now, do I need to know every little line item, every little assumption that you make? No. But if you feel like you can package it in a way that makes sense and is straightforward, go for it. You might, like for example, you might automatically assume in your group that the growth rate in rents is extremely important to include in your set of assumptions. Somebody else might say, for whatever reason, that they don't think that's as important, okay? I'm not saying it is, I'm not saying it's not. I'm saying you...
Trying to figure
I
out.
think it is.
That's the consensus from the class.
Right.
And so we're all using the same.
Yes, same data.
Okay.
You all are using the same data. So in other words, the end result is, it should be identical results. The only difference is the visual component, okay? How you visually represent the data.
So we don't need to put any inputs in,
No.
we just go from this.
Go from this.
Do you want the numbers too?
You need the numbers.
No, well, not in.
Numbers, bitch.
Think about it. What I'm saying, you're all gonna have the same numbers. So yes, I want the numbers, but it's how you present them.
What's the purpose? How is this gonna be utilized in the future?
Okay, once again, every year, you guys go through a capstone project, all right? In that capstone project, you are required to submit a financial package, okay? In that financial package, you are required to give us details as to how you financed it, what the details are on incomes, growth rates, expenditures, rates of return, that sort of thing. Historically, what has happened, not just here, but a lot of other places, you end up with gross inconsistency as to the level of information provided by the students to the reviewers.
Okay.
So you have one group that basically makes the assumption, all we've got to give you is a back of the envelope pro forma with, you know, virtually no information on it, and the reviewers are like, I have no clue what you're actually giving me here because you've only given me this one little tidbit of information. And then you have this other group that chooses to put up pages and pages and pages and pages and pages and pages of tiny little spreadsheets.
Okay.
And you're trying in the back of the room to see what they're putting up there, and you can't see it. You can't figure out what's really going on and what's most important. What we're trying to do is to have a standardized format for the upcoming year in the presentations. The judges were adamant about this, okay? And I would agree with them because I was there as well. That these are outside reviewers. They want to be able to say, all right, I can compare apples to apples with these presentations. This one is, okay, they calculated their return calculations. They're getting a 15% after-tax rate of return. This one is getting a 20% after-tax rate of return. Because all the projects are the same. It's an issue of how they chose to treat them with respect to the details and the background for the financial. That's where this is coming from. And what it ultimately, so what we're going to do is collectively as a group, we're going to see everybody's presentation on the last day of class, and then we're going to kind of go through and we're going to pick them apart and say, wow, awesome, you did an amazing job on this one spreadsheet that captured the rates of return. Okay, but you did a lousy job on this other spreadsheet that was capturing the property level information, but yet, you know, somebody else, you know, maybe Angelo did an amazing job on that one, so we begin to maybe sort of pick and choose and say, okay, let's pick this slide, this slide, this slide, this slide, and then next year, everybody's gonna be basically given a package of, let's say, 10 PowerPoint slides that you just fill in the numbers. Okay?
To be clear, we use the exact same numbers that are already there, we're not looking for
Yes.
property or anything else.
No, this is all about the spreadsheet, all about the presentation with regard to PowerPoint, okay? I would not personally have a problem with using another presentation format like, you know, Prezi or something like that, but I want to be consistent, okay? Everybody has access to PowerPoint, so we're going to stick with PowerPoint, okay?
You have a time yet, or like for a group, or?
Time group is, I mean, it's going to be pretty quick. I mean, because we're looking at the visual piece. We're not looking at the numbers. So it's literally going to be somebody standing up there and going boop, 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 you know, and seeing, okay, I like that one, I don't like that one, don't like this one, don't like that one. And then, you know, we'll try to kind of keep quick little crib notes on it, and then ultimately, then we can kind of go back to those.
But it's gonna be graded on whether or not you can read it back and forth.
Yes. If I can't read it from the back of the room, it automatically fails. Okay? So that is a criteria that you need to basically keep in mind. It needs to be of sufficient font size.
And we're gonna present it here.
Yes. Okay? On either of these or both of these simultaneously. Okay? But the point is, I need to be able to read it from the back of the room. Okay?
So everyone in here sent the same sheet, right?
Yes.
Can you go through the different sheets again, so I can see the size of the font?
Okay.
You have it in your computer, man. It's in your email.
You know that?
How it looks on your
I did that the first class with him, and he's like, I did that first.
Okay. So there's the first one. You can see kind of how big it is.
That's how it looks on your.
Wow.
That's terrible. This is an easy.
Okay, so you get the idea. It's a lot of numbers, but your whole thing is you got to summarize these 4 or 5 pages down into 10 PowerPoint slides that have the key relevant pieces of information. Okay, yep.
Will we have access to that computer to be able to test it
Sure.
beforehand?
Sure, just go ahead and, I mean, this machine you can just log in just like anybody else can and you know, pull it up. I mean, I would sort of, you know, let's just, I'm not trying to belabor this, but let me just kind of, see, to me, that's the sort of, this right here would probably be the minimum font size that you would want to use. But I should be able to come back here and sit down and I can read those numbers. 7,345,356, okay? That I can read.
How much did you blow that up to do that?
That was 200%. Of whatever the font size was
You can also just change the font size too.
No, it has to be visible for a PowerPoint. It's not Excel.
Yeah, it's not in Excel. You're doing this all in PowerPoint. And it is not, I don't know how many times I can say this. This is not a situation of where you are going to like cut out this and then paste it into PowerPoint. Under no circumstances.
Snapping?
No.
Writing it out. Like,
Yes. Yes.
Find relevant information, display it clearly.
Okay. All right. Any other final questions before we move on? Okay. All right. Once again, that will be basically the first half of class on the last day of class. Okay. Okay. Now we're going to do the little quiz and the little test.